Hi, this is Sergio, founding partner of Beta Boom. Welcome to this episode of Startup Basics. So in this episode, I wanted to cover all of the different early stage sources of financing that startups typically get, starting with incubators, accelerators, PreSeed Funds, angels, and angel groups. The thing that I'm not going to be covering in this episode is debt financing and free money, both of which can be really great sources of funding for you guys. So starting with incubators. Incubators, just like accelerators, can really vary. I think they've become so ubiquitous and there are so many of them that what they stand or what people mean when they say incubator can really differ from one case to another. But in general, incubators are typically longer programs that oftentimes provide you with office space, other support, such as access to operational and administrative services. And often there's some kind of component of instruction or learning. And in some cases, incubators also offer very small startup capital. It can be anything from $5,000 to $10,000. But it's typically not a ton of money. And they're really meant to kind of get startups going at the very beginning when you guys may not have a lot of money. You need a place to bring the team together and to get your work done, and to also get resources and help and mentorship. Incubators typically will provide those services and the support and office space for anything between 6 months to a year. Some of them are much shorter, some of them are even longer. I know of one incubator that will actually support startups for up to 2 years. But it can be a really great place to kind of get started if you already have some capital and you can survive on relatively little money, and the main thing that you need is just a place to work and for your team to co-locate and to get mentorship and education on how to run a startup. So the next category of funding and support are accelerators. Now, I think at the last count, depending on who you believe, there's about 3,000 accelerators in North America alone. The term accelerator has really, I think, once again become so ubiquitous and really overused that an accelerator can be anything. And so this is a really important point because I've heard of weekend programs call themselves accelerators, where it's really a boot camp without any kind of financing, maybe some introductions to investors, but it's definitely a far cry from what kind of standard version or what the traditional version of an accelerator is. And there are kind of four main things that signify or that are common among accelerators. One thing is that accelerators typically have a selective admission process, which means that you'll have to submit some kind of application, you'll be evaluated, and not everybody will get in. Some of the most selective accelerators have very low acceptance rate, even as low as 2% or if not lower. So that's one thing. The second thing is that when you enter into an accelerator, you will enter with a cohort, meaning that the investments that they make and that the support that they make are not kind of continuous and I shouldn't say ongoing, but they're not kind of continuous. They work with startups in groups, in cohorts. So it might be, let's say, a summer cohort or a fall cohort or a winter cohort, but you will be in the accelerator program with other startups. In terms of the financing that accelerators offer, it can really vary once again. So the premium accelerators that have global presence and global brands will invest upwards of $100,000, and the amount that they're investing keeps going up almost every year. So probably by next year, whatever figure I tell you, which is usually around 150 for the really premium accelerators, will be out of date. They typically make investments of that range. Some kind of mid-tier accelerators will make investments of about $50,000 up to $100,000. And then there are also accelerators that make much, much smaller investments. And one thing that is really important to understand is that a lot of accelerators these days are nonprofits or are kind of hybrid organizations. Some of them will give you grants, but there is a lot of variability in terms of how much equity they give you and how much investment they give you. But that is kind of the third component, is that there will typically be some level of investment or funding. And probably the fourth kind of typical quality of an accelerator is that there is usually some kind of capstone demo day, and it might be called something different, but it is that period in time when the program ends, all of the participants in the accelerator will present their business or their product to investors, to media, etc. There's also a fifth component, which is very, very common, but not all accelerators have this, is there's usually some degree of mentorship. So oftentimes accelerators will have a long bench of mentors that are successful entrepreneurs or business executives or experts in a given field, such as marketing, that will work with the teams and the founders on various components of their business, whether that is strategic planning and figuring out what is a business model that is actually going to make money off of your product, to go-to-market strategies. Beyond accelerators, another kind of very common pool of money and support are angel investors. So these are folks that sometimes have relevant industry experience. Maybe they were startup founders previously and had a big exit, meaning that they sold their company or their company went public and they made a whole bunch of money that they are now reinvesting into the new crop of startups. Sometimes angels can be other folks with a lot of expendable income. So dentists, doctors, lawyers, they might be investing in startups not only for financial gain, but because this is something that is interesting to them. The kinds of angels or the kinds of people that become angels can really, really vary. And the amount of investment that angels make into startups can also really vary. I would say that an average investment from an angel is probably relatively small. I would, maybe 10,000 to 25,000. Some angels will make bigger investments of 50,000. And then there are what are called super angels. So these are folks that really have a massive amount of financial resources and are very active and make big bets into promising startups, and they might invest $100,000 or $500,000. The important thing to know about angels, though, is that because they come from very different backgrounds and because they have very different motivations and professional networks and experience, there's a great deal of variability in what kind of value they can bring to you. Maybe your dentist might invest $10,000 into your startup, but what are they going to be able to bring to you beyond just the capital? Are they going to be able to connect you to other investors or to customers of your product? So it's really important to understand what is the value that they're bringing. Of course, that is in an ideal world if you can have both the capital that they offer as well as some other kind of value add in terms of knowledge or connections that they can bring to the table. Finally, the fourth group of investors or resources, investment resources that early stage startups typically have are angel networks. So angel networks are typically groups of angel investors that come together and invest as a group. And they deal source, meaning they find startups to invest together as a group. Oftentimes they're very professional. They have websites and very kind of sophisticated and well-established application processes. So, they find startups as a group. They do due diligence as a group. So due diligence is when investors kind of take a look at your business and do their due diligence. Look at your numbers, look at your financials, speak to your customers, make sure that you are not stretching the truth or outright lying about certain things. They might do reference checks with, former employees or other service providers, or basically they're trying to really get a strong and accurate sense of the health of your business, as well as your qualities and trustworthiness as an entrepreneur, as a founder. So they will often do due diligence as a group as well, and they will make investment decisions as a group as well. So depending on the angel group, there might be an investment committee that is comprised of just a subset of the entire angel group that will say, we're going to invest in this company, or we're not. Or sometimes members of the angel group will kind of band together and make investments as kind of a subgroup. It really depends. And the amount of investment that angel groups make really varies as well. Some of them make relatively small investments of $10,000 into a given startup, while others will make much bigger investments of $250,000 or $500,000, depending on the quality of the startup and the stage of the startup. So that is, once again, there's a great deal of variability there that you're going to have to navigate, unfortunately, and you're going to have to do investigation on your end and figure out, okay, this angel group, how much do they typically invest? Are they worthwhile? Are they even aligned with what you're doing? So some angel groups will have interest areas. They might be interested in healthcare or ed tech, etc. The one thing that I will note, though, is that because angel groups have, because they kind of act almost as semi-professional venture funds, so it's sometimes even more sophisticated than some funds that I know. Their process from when you apply to when a check is written can be really, really long. It may actually not be worth your time to be spending months, applying to and going through due diligence with an angel group for a relatively small check size like $10,000. You might be better off approaching individual angels in that same amount of time and hopefully getting, a handful of $10,000 checks rather than just one. So that's something to definitely watch out for. The last group of investors of startup funding are pre-seed venture capital funds. Actually, there are two more. Sorry. So that's we're gonna make the last one the bonus. So pre-seed venture capital funds are a new kind of crop of venture capital funds that have recently popped up. Because what has happened in the recent history in the VC world is that what were once called seed funds, that were meant to provide the initial capital for startups to build out their product and kind of test it out initially in the marketplace. Those seed funds have started to make bigger and bigger investments and write bigger and bigger checks into more and more mature companies. And so there's this kind of funny dynamic that has happened where seed funds really aren't providing seed capital anymore. They're kind of providing more growth capital to companies that have built a product and proven it to some degree in the marketplace, and seed capital is really now, allowing those companies to get more traction, to kind of fine-tune their operations, their go-to-market, and how they serve their customers. So there's kind of a saying in the VC world that, seed is the new Series A. But to replace that initial capital, other firms have started to write smaller checks again and call themselves pre-seed. And I'm sure that, the long-running joke is that, in another couple of years we'll probably have pre-seed firms, but that's just how things work in the VC world, and it's kind of nonsensical. But anyways, that's what it is. And so pre-seed firms can, once again, vary quite a lot. They typically tend to be smaller. So some VC funds can have quite a number of investors on their staff, but most of the VC funds that we're familiar with, that I'm familiar with, tend to be kind of a smaller size, which is great because they give you a lot more kind of personal attention and add value in other ways than just providing you with capital. Pre-seed funds can write checks anywhere from $25,000 all the way up to $750,000. Obviously, the ones that write the bigger checks require startups and founders to be kind of further along and to have a higher level of pedigree and really be more investable, whereas the ones that write smaller checks will take a little bit of a bigger gamble. So if your startup is relatively early on, it's probably good to start with the pre-seed funds that write smaller checks. And I would say on average, pre-seed funds write checks anywhere between 150 to 400. I think a sweet spot as it stands right now tends to be between 200 and 300K. So now for the bonus. The group of investors that nobody really talks about, but they really should, because they are as big as, if not bigger than, the venture capital industry, are family offices. So family offices are kind of interesting. They tend to be kind of professional investment companies that are investing the wealth of really high net worth individuals. So these might be folks that, made $100 million from, previous company, or maybe, they were really big, well-known executives that amassed a fortune, really. They will often hire professionals to manage their wealth for them. So not relying on other institutions, but they will have kind of their own investment operations, and they will hire professional investors or teams of investors that will allocate their capital into various investment categories, and that can be venture capital, private equity, real estate, all kinds of things. Family offices, just like everything else, varies a lot. You can have smaller family offices that make smaller investments into really early stage startups, all the way up to multifamily offices that combine the net worth of multiple high net worth families into kind of an umbrella organization. And they might only write big checks for companies, for startups that are really well developed, or they might only invest in venture funds such as our own. However, there are a lot of benefits, I think, of going after family offices. One of them being that they are much more sophisticated than, I shouldn't say more sophisticated, but they can really provide kind of the value add of angel investors, but kind of the rigor and the structure of a venture fund or an angel network. So that can be really, really good, because they can really make some introductions to potential strategic partners, customers, advisors, etc. And they are typically also in a position to make bigger investments and then make follow-on investments. So, when you are just starting out, a family office might make a $50,000 investment in your startup, but then when you're raising your seed, your business is doing really well, they might then come in and invest in that round, whereas, a smaller angel investor may not have the means to write a $250,000 or $500,000 or $1 million check. And I think that, the important thing is that there's a lot of family offices and there's a lot of potential investment there. The really, really tricky part is that they, are often very secretive and do not kind of advertise themselves like venture capital firms do. So venture capital, their really, mandate is really to get as much deal flow and talk to as many startups as possible. Whereas family offices can be a lot more secretive. And so it's really hard to identify family offices and multifamily offices. This is a topic that we'll discuss in a future episode, but I just wanted to let you know that they're out there, and that it's a really great source of funding. There's a lot of capital in family offices, and they tend to be sophisticated value add investors that you should definitely keep on your bucket list of potential investors to reach out to. So hopefully that demystifies some of the sources of early stage startup funding. If you have any questions, definitely add them below. make sure to subscribe and hit that bell button to get updates from our channel. See you next time on Startup Basics.